Hello everybody and welcome to this quick video on my best 10 stocks. I have 10 stocks that I like the most right now and that are the biggest positions in my portfolio. So if you're used to these videos, you probably know that all you need to do is perhaps pause and look at how the metrics have changed compared to the last time I did this video 2 weeks ago. But if you're new to the channel, really briefly, here's how I do things on this channel. So I invest for revenue growth. My style of investing has everything to do with product adoption. I want to invest in companies that see their products or services adopted. That's the whole idea of my self-investing this is the S curve, a product adoption curve. I want to go in early at the early signs of product adoption, and I want to get out when there's a sign of growth slowdown, as evidenced by a durable durable decline in the growth rate, in the revenue growth rate of these companies, knowing that the decline should roughly equal to the rate of growth of the economy. That's when I consider a stock not to be a growth stock anymore, when a stock grows at the rate of the economy. And another important point about this channel, which is called Beat the Denominator, the reason why I want my stock to have revenue growth at 30% minimum, and some of these stocks have changed, but when they entered my spreadsheet, when I made the investment in these stocks, they were predicted to grow at 30% annually, annual revenue growth 30% over the long run, and I still believe that's the case, right? I believe Enphase will rebound handsomely and we'll have 50% year-over-year growth in Enphase. Airbnb right now, there's been too much travel. People are taking a break from traveling, but I think over time people are going to shift from hotels to Airbnb. So that rate right there will go back to 30% over the long run. I look for 30% over the long run because the real return that I look for is 15%. The nominal return right here, which is noted right here, those 40% growth, the nominal return has to be 30% in order for me to get a 15% real return. Why? Because of monetary inflation. I consider monetary inflation to be a real threat to investment returns, and the money supply, in my view, will keep increasing at a rate of 15% per year over the foreseeable future. I believe that right now, the monetary tightening that we're seeing will just be followed by insane monetary printing come when the government needs to finance those bonds, right? So as the government finances those bonds, we saw the auction yesterday did not go well at all. As the government needs to finance ever more bonds, quantitative easing will need to come back, which in my view will lead to this increase in new dollars. New dollars will increase, in my view, at 15% a year going forward, and that's faster than historical. Historical, it's been about 11%. If you go way back, it's been about 7 or 8%, but you have to go way back to get to these levels. So I want to beat the denominator growth. So now that I've put this out of the way, let me tell you about the 10 stocks in the portfolio. So the first stock, which is a little above 40% now, is Tesla. I believe Tesla is an undervalued asset right now. Quite frankly, quite honestly, it's a magnificent 7 stock. It's been left for dead for ever since February or March of this year, in my opinion. This stock has a lot going for it. It has held its market share in EVs. If you believe electric vehicles are going to be the main product in the future, which is what I believe. I believe gas cars will be gone come 2027, 2028. Then the leader in that space, Tesla, should gain major market share, and they have guided over and over and over again for 20 million cars by 2030, and I am holding them to that goal. And if you hold them to that goal, you should see actually 50% revenue growth until 2030. Analysts are only saying 37% because we're very bearish, but in my mind, there is little doubt that Tesla will reach the 20 million car a year goal. The worst case scenario, and that's always been a thing for Tesla, the worst case scenario is they reach it in 2032 and not in 2030 because they have a tendency to overpromise, which Wall Street really doesn't like. But one thing you can say about this stock, Tesla, is that it reaches its goals albeit late, it typically reaches its goal. And if it's 2032 or 2030, doesn't change much for me in the grand scheme of things. I'll still be a net buyer of stocks, and I'm really happy buying the stock at $207, $208 right now. I think this stock is heavily undervalued for the quality of the business that you get. The other stock that I like very much is Enphase. Enphase to me is a similar story of product adoption to Tesla. So Tesla is the adoption of electric vehicles, betting that most cars will be electric. Enphase is the adoption of residential solar, betting that most homes will have residential solar on their roofs in the US and around the world, because it is the cheapest source of energy, because it is a decentralized way to make your own power and to not be dependent on the capital expenditure of utilities that they pass on to you. It's a way to decouple your household from the increases in energy costs from the utilities, and also energy independence. I'm very bullish on Enphase. Enphase right now, there's been a clear slowdown in Enphase. And this explains why the stock has been entirely broken by this market. I don't understand how low this stock is trading, but it is trading this low, and now to me is a time to accumulate Enphase, because yes, there is a slowdown. Yes, they shipped too much to distributors. Yes, it's the second time they make the mistake. In my view, with how bad of a guide they gave this time, I have to believe that it's not going to get worse, especially as we begin to see signs that interest rates will ease. These, Tesla and Enphase, are two stocks that are heavily influenced by interest rates, whether it's a $30,000 car, $35,000 car, or a $35,000 roof. Well, actually a little cheaper for a solar roof, maybe $25,000. Either way, both of these expenses you typically buy with debt. With current interest rates, that's putting a slowdown on this. But remember what I told you about monetary inflation. I believe interest rates will go down. There's no other way. The U.S. government has to find a buyer for these treasuries. And for this to happen, there has to be a wave of quantitative easing again, with the government buying the Fed buying a whole bunch of debt, like mortgage-backed securities and treasuries, of course. And so to me, Enphase is cheap. My spreadsheet is not kind to Enphase right now because of the 15% revenue growth rate. But if you believe over the long run, this is a 30 to 40% annual growth company, then you would get a enterprise value over gross profit over revenue growth of under 0.2 here, which would be very good. By the way, I don't think I've said this in this video, so if you haven't seen this video, this is enterprise value over gross profit over revenue growth. That's my spin on the price to earnings to growth ratio of Peter Lynch. I'm asking the question, how much am I paying for each percentage point of growth? And I want it to be as small as possible. All right, the third stock that I have, which is my second biggest position, it's an asset. I call it an asset, although I own some of it in the form of a stock. The stock that I own is MicroStrategy, but most of it is in the form of pure Bitcoin that you just store in a brain wallet, essentially. That's my big position. I am not a believer in bonds, obviously. Evidenced by what I said, I would never touch a bond. I'm not a believer in bonds, and I think the safe asset that is replacing the bonds today is Bitcoin. Bitcoin, I've covered it many times on the channel. I'm not going to spend a lot of time because I know a lot of growth investors do not understand or want to speak about Bitcoin. But Bitcoin, in my view, is an asset that is going to keep seeing exponential growth as it gets adopted and as people move away from bonds in their portfolio. When you buy bonds, you just buy money. That's all you do. When you buy bonds, you buy cash that will be paid to you in the future. It's a contract on cash that you get back in the future, plus an interest rate. That's all it is. I believe people will save in money, but instead of saving in the hardest fiat money out there, which is treasuries, US dollars, they're going to save in the hardest money that has ever been created, which is Bitcoin. Bitcoin is hard money. Lots of catalysts coming up for Bitcoin next year, right? Early next year, likely, we're going to have an ETF. And then we have a halving in April. So the halving means the supply of new Bitcoin released into the market will be cut in half. And so theoretically, if the demand stays the same, the price should double. That's just theory. You don't know. Maybe the price, maybe the demand will drop, but I don't think so. I've been in Bitcoin for quite a long time. I'm actually one of the earlier Bitcoin proponents. I've been talking about Bitcoin to whoever will hear long before this YouTube channel, actually since 2015, right? 2015, and I made the mistake of selling it much too soon and much too early because I was listening to mainstream media telling me how it's a scam and how it's rat poison. But when you think from first principles, you believe your own research. That makes you humble. That makes you believe your own research and not believe whatever the bears, whatever stock cues say. No, you just gotta believe your own research, right? All of these stocks are my own research. Nobody tells me to like any of these companies. This is what I see come for these companies. That's why I own them. Let's talk about HIMS. So HIMS is a company that has come back down yet again. Yesterday, stock dropped quite a bit. It's as if the market forgot that they had an outstanding quarter with accelerating growth, accelerating adoption, weight loss product coming. Actually, some analysts updated the growth, and we're going to see about 59% next 12 months growth for HIMS. So that's outstanding. I believe they may actually do more if their weight loss drug catches on, not drug, but compound that they're releasing. HIMS is the cheapest stock out of all of these stocks. You're paying 0.03 for each percentage point of growth in HIMS. So it is a stock that is entirely dismissed by the market because it used to be a SPAC, right? That's just the way it is. Moving on to CrowdStrike. So what about CrowdStrike? Well, CrowdStrike is a stock that I like. It's a little bit of an expensive stock. I mean, per this spreadsheet, Tesla, if you look at enterprise value gross profit, Tesla may be even more expensive per this spreadsheet than CrowdStrike. But CrowdStrike, if you look at a price to sales basis, it's pretty expensive. But I believe CrowdStrike has a near monopoly in cloud security, right? The way CrowdStrike works is they have the biggest network of computers connected to their system. And because of that, they're able to detect the threats before anyone else, because they have the biggest networking of computers. And when there's a threat, when there's a breach, right? CrowdStrike is a quote-unquote firewall for the cloud, built on the cloud, in the cloud. And so when there is a breach on your device, it connects to the cloud and say, hey, I'm device number 500 million something. There's been a breach here. And it broadcasts to all of the other devices on the network, get a broadcast. There's been a breach, and it updates. There's an update. This is how, roughly, back of a napkin explanation of CrowdStrike. It's network effects for cybersecurity. They were a pioneer in that space, and we have long-term guidance on this stock until 2030. Great management, great CEO, and by great, what I mean when I say great management, I say they keep executing and they keep beating their targets. That's what I mean by a great manager. So it's very, very similar. This great management, say, for a company like CrowdStrike is really similar to a great management for a company like HIMS, for example, right? And FaZe and Tesla, I'm very bullish on both, but they've not consistently beat their guidance. Management tends to sometimes be too optimistic, overpromise, underdeliver. That's not what you want to do. You want to underpromise and overdeliver, and that's what HIMS and CrowdStrike keeps doing. Not that it makes much of a difference in stock prices over a short term. If you believe HIMS, HIMS is the cheapest it's ever been, and they're doing amazing, and the market is trading it at the cheapest valuation they ever traded it at. So anyways, that's just the way it is. Mercado Libre is a steady Eddie, sleep well at night stock. Leader in Latin America for e-commerce. The number one e-commerce. There's a lot of competition in Latin America for e-commerce, but they are the number one by about 10% to the next best player in Latin America. They have a fintech division that is doing well, focusing a lot on micro businesses. They have a payments division. They have an exciting logistics division. They have an exciting advertising division. It's really similar to an Amazon story, with a fintech without AWS. And of course, a lot of people love Amazon for AWS, but that's why Amazon is not a hyper-growth stock. Amazon is really a steady Eddie growth stock, right? Mercado Libre is an hyper-growth stock at 37% revenue growth. That is an hyper-growth stock. It's much earlier in its growth phase than, say, a company like Amazon, which is why I like this stock very much. Then let's talk about StoneCo. So StoneCo, Stonier in Brazil, as they call it. StoneCo is the second cheapest stock in my spreadsheet at a 0.04. It's tough to understand how cheap StoneCo is. StoneCo has been dismissed by the market because they had a collateral issue in early 2021, long before the big crash, that we've had, which happened more towards late 2021, if you remember it. Some high flyers really had issues early 2021, but really the big crash came late 2021. So StoneCo is I'm sorry, there's landscapers making. Anyways, StoneCo is an amazing an amazing company because it's doing very well in Brazil. It's the number one Square terminals, the equivalent. They sell Square terminals to medium-sized and small-sized businesses in Brazil. So the good way to think about StoneCo is think about Square without the Cash App. So it's a Square without the Cash App. And they are the leader in Brazil in that space, ahead of PagSeguro. And really, quite frankly, it's a fintech, and I love that very much. But what I love even more about StoneCo is the valuation. The valuation is ridiculous. The market has entirely forgotten about that stock. I don't know what's going on in the market. They entirely forgotten about it. All right, let's talk about Nubank and SoFi. I like both Nubank and SoFi. It's hard to choose for me which one I like the best. Right now, I find SoFi more undervalued than Nubank. I mean, no surprise to anybody looking. Like, SoFi is dirt cheap right now, and there's a lot of coverage on SoFi. I believe Nubank's growth is really fueled by its app, which is a leading app in Latin America, which has become a desirable consumer brand. Like, since when has a bank become a viable consumer brand that people are proud to be customers of, right? This is what Nubank is. Nubank is exhibiting hyper growth, at 80% for next 12-month growth, 80%, 60% margins. And, I think they've really cracked the playbook of being the bank for Latin America. They are the absolute leader in Brazil, and in every country they enter, they soon after become the leader. They're taking the lunch of legacy banks, and they're onboarding customers that were unbanked or never banked before. So this is why Nubank, in my view, is a, it's kind of a sleep well at night neobank, if you know what I mean. The stock has been doing very well, and the performance is outstanding. And don't forget that this is the point that I was making in a video a few days ago. If a company is 80% bigger today than it was a year ago, and the price to sales does not change, the price sales ratio does not change, then that company should theoretically be 80% more expensive, and you're actually paying the same price. So it's important, in my view. I try to not shy away from a stock that I see up 80% and telling me I've lost the run-up. No, I haven't lost the run-up. The company got 80% bigger. It got 80% more revenue now than 12 months ago. So it's a bigger company, right? You're paying the price for right now, for the business right now. And anyways, Nubank is dirt cheap at a 0.24. Under my average. Very cheap here. And then the last company, SoFi briefly. SoFi is a neobank, I would argue, for higher end clients that are Gen Z, that are millennials, people making more than $100,000 a year, for example. People who can afford expensive concerts. It's a bank for a tiny sliver of Gen Z and millennials who are more sophisticated and who want to quote their motto, get their money right. Who want to get their money right? They have coaching, they have advice, financial advisors, ETFs, cryptocurrencies, credit cards. It's a one-stop shop for the sophisticated fintech user, is how I define SoFi. And so they're going after a customer that is a more well-off customer. And to me, the big analogy that I would do to SoFi is the Cash App. Cash App is more of a mainstream bank trying to replace banks and being more mainstream. And SoFi is really trying to go after the sophisticated customer. Anyways, the stock is dirt cheap. The stock is also forgotten by the market. Nobody cares about high-growth companies right now. The last company that I have is Airbnb. So Airbnb, stock that used to be growing much faster now it seems to have settled at 22%. I believe this will increase again, in my view, but we don't know. Airbnb when you listen to their call, you may know that they claim to be about 10% on the way into their disruption of hotels. Just 10%. Right? Out of 10 people that could use their Airbnb, you still have 9 people who have the habit of going into the hotel. So they've barely broke into that market. Barely, right? And this is a stock that's extremely profitable. I don't have it in this spreadsheet, but if you look at the EBITDA margins of Airbnb, it's a stock that's very profitable, and you have actually a shareholder base of value investors in Airbnb as well as growth investors. I buy the stock for growth, but some people like it for value. And I just want to say, and I'll conclude on this, out of all of the stocks that may attract value investors, I would put Enphase, I would put HIMS, and I would put StoneCo, and I would put Airbnb as stocks that also would attract value investors, right? It's crazy that we have companies growing this fast, trading at such low valuations. It's crazy, HIMS, enterprise value gross profit at 2, right? StoneCo at 2, right? Anyways, Enphase a 7. This is pretty inexpensive stuff. So we'll see what happens. The market was pretty bearish yesterday. It's the same incredible narrative of Mr. Market. Rates up, stocks bad. That's the narrative. That's what happened yesterday. There was a bad auction of the treasuries. There wasn't a lot of demand for treasuries in the treasury auction, and so the stock went down. And then you had Powell who doubled down on saying, "Oh, we may raise interest rates." Anyways, this is the longer this lasts, the more we have time to accumulate these companies. And it may not feel good. It may not feel good to see the portfolio be down, for some stocks 30%, for some stocks 50%. And if you see that down price on your portfolio, I'm speaking for myself. I have a few stocks that are down minus 30, minus 50%. It's important to zoom out, right? Because you probably see the minus 50% or the minus 30% because you have your broker set up to last 12 months or year to date. Set your broker to ever since you've held the stock, and then you'll see if you own growth stocks long enough, it's all green. If you've held growth stocks long enough, it's all green. My Tesla is well into the green when I look back. My Bitcoin is so green, it's not even funny how green it is, right? And I believe this will be the same for Enphase. Right now I'm in the red for Enphase. That's okay. I believe over the long run it will be the green, Nubank, I'm well into the green on Nubank, right? Airbnb, well into the green on Airbnb. Mercado Libre, well into the green. CrowdStrike, well into the green. But you got to zoom out. You got to zoom out to see the green. Anyways, just a small tip here. But anyways, this is no tip, by the way. This is no advice. There's never any advice on this channel. This is not investment advice. This is just entertainment. I hope you were entertained. I appreciate your likes. I appreciate your subscribes. Thank you for watching and have a wonderful day.